Hey everybody, Scott Voak with Voak Homes at Pacific Sotheby's here. Hope you're having a great day. It's time to take a look at San Diego housing statistics through April of 2025. Apologize, I'm once again shooting out of my home office, and many of you know I've recently moved. We're in East Poway and we have a bit of a ranch. So in the background here, there are 56 chicks that are making a whole lot of noise and one dog snoring. But we'll try not to let that distract us. Let's take a look. As per usual, I'm going to focus on detached housing for the San Diego market. The attached market just ends up selling a lower volume and a lower price. Usually does track the detached market in trends though. So let's focus on the detached here. You can see that we had a slight drop. We went from $1,080,000 to $1,075,000 in our median price. And once again, median price is more of the price of the average house. Whereas if we look here, this is the mean. We're looking at the average price of all houses. So as you can see, we've got a slight increase over the last 3 years, but really kind of a choppy market. Let's take a look at this same statistic over a 10-year period to get a little more depth and a little bit of understanding of where we've been in the housing market. As you can see, when we spread that 3 years out to 10, we've seen a definite increase. And one of the reasons that we've actually been more choppy in the last 3 years is the incredible increase we saw right here. Okay, so what we saw an incredible, we went from $1,110,000 to $1,350,000 literally in a period from December of 2021 to March of 22. That was explosive. And so since then, we've just kind of been choppy. And if we're comparing that 3-year graph we looked at, it was ending right here. So you'll start to see the 3-year graph we show look more of an increase as we start knocking off April, May, and June of 2022 off of our chart. Next thing I always like to look at is supply and demand, tell us where we're going to be going in the future. You can see we continued to increase our number of sold homes. We knew this was going to happen because last month when we looked at the pendings were increasing. So those pendings now closed, and you can see we're up nicely on the month. We closed 1,456 homes. These are once again detached homes in San Diego County in April through the MLS, which is an increase of 8.7% over last year, and a really healthy jump over the previous month. So see that we jumped about 300 homes, jumped about 20% in 1 month. This is the time of year when we expect to see that, but it's nice that we are seeing it. Now let's look at what next month may hold. As you can see here, looking at the pending sales, we had a little bit of a dip in April, which portends a little lower volume of closings in May. Now, I'm not really surprised by that, and the reason is taxes. Once you get to April 1st, people are focused on their taxes. We see traffic at open houses die down. Just the number of transactions slows down because people don't know if they're going to get money back or they're going to be writing a big check. And even if they know, they've still got to put the paperwork together. So we typically see the first half of April as really slowing down. And then on top of that, you've got Easter, and that just kind of gums up the works. So let me in fact show you. I hope I'm right. So March, April fell. Let's look at last year. March was up, April fell down. Previous year, March was up, April was about even. Come back here, March was up here, April was down. So that's 4 out of 4 months, 4 out of 4 years where we've seen April sales be slower, April pendings be lower than March's, which is going to portend to a lower number of closed homes in May. And I really think it's due to just the cycle of the U.S.'s tax system. Everybody's doing their taxes in April, and so they're not buying houses. Although they're not buying houses, apparently they are listing houses. As you can see, the number of listings went up again. So we're now sitting 9.5% above where we were last year. That's a pretty healthy number. Now we're still below where we were during the pandemic, but we are starting to increase, and combination of more new listings with fewer homes going into escrow, expecting that we're going to see the overall number of active listings go up. Remember, this is just new homes put on the market last month, and there were 2,219, which is an increase of almost 10% from the previous year. Well, let's take a look at what that did to the overall supply, which is our active listings. As expected, Overall active listings increased and significantly. We are now up 33.7% above last year. So we have a situation where we have a clear increase of inventory. We have demand was down artificially for tax reasons last month. Overall, it has been rising, but not as fast as the supply. So let's look at what I call is the major statistic we want to look at, which is months of inventory, and see what that looks like. As expected, months of inventory rising very quickly. We are now at 2.7 months, which is a 28.6% increase over last year. The attached market is even higher. It's about 3.5 months. This is high for San Diego, at least in recent history. Let's take a look at the same statistic as long as the MLS goes back, and we can kind of see where the peaks and valleys have been. The main thing I want to show with this chart is where we were at the housing crash. Give us a little perspective. Back here in 2008, we were sitting at 13.5 months of inventory. So right now we're like, seems like a lot of inventory, and it has been a gradual increase, but we're sitting at 2.7 months. So we're a long, long way from a housing crash. And a reminder, you can go back and look through this playlist, go back a couple of years, I did a video on why this is false data. And in reality, what should have been happening here is this was a gradual decrease. And just real quickly sum it up, for those of you who don't want to go back and find the video, is there's a status in the MLS called withdrawn. And if a listing is withdrawn, rather than canceled or expired, another agent cannot call to solicit that listing. So what a lot of agents were doing was when a seller wanted to take it off the market, they were making it withdrawn, putting the expiration date 10 years out, so no other agent could ever solicit that person's business. Well, the MLS finally caught on to it, because what that does is it leaves more homes actually on the market. So withdrawn is technically still for sale. So it added to the inventory. 2019, the MLS figured it out. And you saw in a 3-month period, thousands of listings come off the market, and they were all from the withdrawn status to expired. And that was just a case of agents were trying to either game the system and limit their competition, or literally help out sellers. Because if you've ever taken a house off the market, you realize that there are firms out there that collect your number from many sources, and 100 agents will call you the day after you take your home after the market, swearing that they have a buyer and that they're a great marketer and can sell your house, when they just had 3 months to sell it when it was on the market and couldn't. So this number is, this part of the graph is bogus, but in reality, what we really should have had was more of a gradual drop, but you can still see the trend is reversed and we're starting to increase. Am I concerned about it? No. I think anywhere between 2.5 and 3.5 is a healthy market. Right now we're sitting at 2.7. You get under 2.5, and that's where we see more of the multiple offers and you know, kind of the frenzy more across the entire market. You get above 3.5, and people are going to be able to negotiate a little bit better. So what does this all mean? Well, we're seeing inventory increase. We're seeing demand kind of hold steady. Really what we're seeing in the market is a lot of turmoil, a lot of uncertainty. Nobody wants to make their biggest financial investment in a time of great uncertainty. And with the tariffs going on, interest rates being high, more violence breaking out around the world, people are unsettled. Nobody's really sure about the jobs, you know, who's going to have a job with the tariffs, who's going to get a better job, who's going to lose a job. So expect things to stay kind of choppy. I expect demand to stay low while supply will increase a little bit. And the reason supply will increase a little bit is uncertainty and stress in markets and in lives also leads to divorce, also leads to people moving out of town. And so you will have some of those houses sell where you won't have the people who are excitedly coming in the market to buy their first home or move up. So expect inventory to increase a little bit, demand to kind of stay the same or maybe fall, unless we start getting more good news out of the trade deals, you know. So expect the number of homes for sale to increase, the number of buyers to stay the same, maybe decrease a little bit, up until the point where we either get a significant decrease in interest rates down to below 6.5%, or we start seeing a lot more trade deals like the deal we recently had with Great Britain, kind of calming the markets down and things really taking off. So we see that happen, the market come back. What are we seeing right now on a kind of feeling in the market? Well, I'll tell you that unique homes, there is still a demand for them. For example, have a client looking in La Jolla, ocean view property, built in the 70s, original owners, needs a lot of work, but didn't have to be done immediately. It's like you could move in and you could expand it later. 100 people through the open house. This house is selling over $2 million. They had 6 offers. Only one of them was at or below asking price. So really intensive. Another house in Poway, similar situation. They priced it a little aggressively in the $1.8 million range. 100 people through the open house. Just kind of insane traffic. On the other hand, you get into a subdivision, say San Elijo Hills, Forest Ranch, Stonebridge, any place where you've got, more than 1,000 homes and a lot of them look alike. Okay, maybe a builder built 30 of the same model. What we're seeing there is if the house is absolutely recently upgraded, so you've got the quartz counters, you've got solar, you've got a bedroom downstairs, you have something else that everybody else doesn't, a view, a lot of privacy, an extra large lot. You got something like that, your house is going to sell, you're going to get a premium price. However, if it's a 15 to 20-year-old house, you haven't upgraded it, you don't have solar, you don't have some of the things that people are looking for, like the bedroom downstairs, or you don't have a view, you're going to have a hard time moving it. And it's basically going to come down to that situation to a price per square foot. We as agents can influence that price by 2 or 3% through the negotiation. But if you price it too high and only get one offer, and you only get that after 30 days, you don't give us as your agents the chance to negotiate your price upwards. So the better strategy on what we have found working is price on the bottom end of the range if your house is not exceptional in some way, and not exceptional to you because you really liked the color of the paint or because you liked the roses in the front. That's not exceptional. I'm sorry. You've got to have something that other houses don't have and can't get. I can replant a garden. Even a pool, I can put in a pool if I really need a pool. But if you've got a view, that goes really well. If the structure is such that it's conducive to a multi-generational family, that's going to appeal to some people. If you have no neighbors, that will appeal to other people. So if your house has something that is not duplicated in the neighborhood and can't be duplicated, you're going to be able to drive a better price. If it's very similar to all the other homes in the neighborhood, my recommendation to my clients is go at the bottom end of the range you think it's going to be priced, it's going to sell at, get multiple people in and give a chance to bid it up. The worst thing you want to do right now is go at the top end of that range and try it out for a month and then start dropping, because you're going to do what's called chasing the price. You're going to start at $1.5 million, then you'll drop at $50,000, and then you'll drop at another $50,000. 45 days in, you're now where you should have been 45 days ago, but the market is down a little bit. So don't do that. If you really want to move, especially if you're one of those people who's fortunate enough that you've already exceeded the $500,000 capital gains exemption, so now you're only getting a 65 cents on the dollar, you're better off sell it now, sit on the money, and go find somebody else who needs to sell in your next home, rather than chasing the price down and giving yourself a heartache. So if you have any questions specifically, give me a call, hit me up in the messages below. Also on this channel, we are continuing along with our development project in City Heights. We'll have another video posting shortly. We're getting really excited. I just purchased a bunch of appliances for that, so go ahead and subscribe if you'd like to see that. Other than that, thank you for watching the whole thing. I really appreciate it. Subscribe if you'd like to see more. Have a great day.